Welcome students who are taking financial accounting, and in this series of videos we are going to be working on the chapter 2 short exercises that were assigned in the study guide, the digital study guide for the chapter. We have to do short exercises, and then we will be doing the exercises group B and then the problems group B, but this series of videos is for the short exercises. To get the most out of these videos, the best thing that you would do is to work through the problems yourself and then double check your answers in the solution manual. And of course, if you get it right, really there's no reason why you should be watching the video. But if you get it wrong and you look at the answer and you try to figure out how the answer is arrived at, and if you still can't figure it out, then obviously watching the videos makes sense, because then you can see me work out the solution to the problems itself. And I'm going to be working it from the perspective of a student. Even though I have the solution here, I try not to look at the solutions. I try to work through them, and just from here's the problem, here's the piece of paper, let me work through it. And I also try to brain dump, meaning I just blurt out stuff, whatever pops into my head that might be of help. Any ideas that I have, I try to incorporate into the videos. So hopefully that'll be additional help. And also be aware that as I'm working through through chapter 1, I found myself I kind of try to say, oh, well, it should only take me 10 minutes of video. But obviously that's not possible when, if you look at the amount of time it takes to do a problem. If it says 25 to 30 minutes, obviously it's going to take me multiple videos to work through a problem. So, bear that in mind, that some problems I might get through really quick. Like, for example, the first one that we'll do, it says 5 to 10 minutes. Well, I might get through that really fast if it's me, okay? But because I have to explain, or I might, things might come into my head, it's going to take some time, all right? And then when it gets really complicated, it takes a little bit more time. But it's, hopefully you get something out of these videos. Because it's in video format, you're able to pause, rewind, watch it again. And even though I'm doing this ad hoc and I have a tendency to scribble, talk fast, and just blurt out stuff, by being video, you can pause, rewind, and watch the video again and again and again. But if you still don't understand it, then definitely telephone and speak with an instructor. I mean, you can contact us via email, but when it comes to understanding, which is what financial accounting is about, it's generally better to have a two-way conversation. Email makes that a little bit difficult. All right, so with that said, let's get started here and get down to the next slide. And let me get my digital pen. All right, here we go. All right, so it says here, account types. All right, for each of the following accounts, place the corresponding letters of its account type in the space provided. Use the most detailed account type appropriate. All right, so account type is basically what I like to call the category of accounts. Okay, so you have assets, liabilities, stockholders' equity, revenue, and expenses. And the idea here is that you should understand, what that category is. I mean, assets are something we own, O-W-N. Okay, liabilities are something we owe, O-W-E. Stockholders' equity is the investment in the business, or the net worth. Right? Revenues are the sales and the operation of the business. And the expenses are, cash outflows during the operation of the business. Okay. And here's one of those cases where, it just popped in my head. One of the generally accepted accounting principles, all right, GAAP, one of those accounting principles is called the matching principle. And the matching principle says that we want to match up our revenues with our expenses. Okay, so why are we in business? Now remember, revenues and expenses are for the operation of the business, right? That's our day-to-day operations. I mean, we're in business to sell stuff, and we have expenses that we incur that we match up to those sales. Okay, so when you're looking at the matching principle, and the way to think about these categories is, assets, liabilities, and equity are on your balance sheet. And of course, your revenues and expenses are on your income statement. Right? And I know I've said this before, but the balance sheet is the financial operation of the business. It's the financial position of the business since the start of the business, whereas your income statement shows the operations of the business on a periodic basis. Okay, so with that quick little background, well, let's get to the answers here. So dividends, it's already showing as stockholders' equity. All right, I somewhat agree with that and somewhat disagree. When you look at and if you've watched previous videos, you've seen me do this, assets is equal to liabilities plus equity. And when we consider equity from the perspective of a corporation, we have common stock and we have retained earnings. All right. Those are like general ledger accounts if this is a corporation. If this was a sole proprietorship, you would have a capital account and you would have a draw account. Now, if it's a sole proprietorship, you're not going to pay dividends, okay? Because any profit or loss that you get that the business makes goes right into your capital account, okay? So dividends don't come into play when you're talking about a sole proprietorship, but when you're talking about a corporation, people have purchased stock in the business, and the dividends are like a return on your investment. So where does that money come from? Well, it's returned to the business, it's returned to the stockholders in the form of dividends. But where do the dividends come from? Well, they're saying that the dividends, it comes from the stockholders' equity, okay? And it should come out of your retained earnings, right? Now, the reason why I say I agree and disagree is because when you look at the income statement, you have revenues less your expenses, okay, which gives you a profit or loss. Now, if you have a profit, okay, the business will generally then declare dividends, and then they'll take the dividends out of that profit or loss, which would give you your net income. Okay, but that net income then, at the end of the accounting period, we close out to retained earnings. So most often the dividends will come out of the profit or loss that's being shown on the income statement. Now, granted, even if you don't pay dividends, that profit or loss comes over here to the retained earnings, and that's why they're showing this as stockholders' equity. Okay. Or but most often when a business does not have a profit and they have a loss, they generally don't pay a dividend when they're having a loss. Okay. I mean, will there be times where there is no profit and they pay out a dividend? Sure, especially if it's a big corporation and they're known for paying dividends on a timely basis, like every quarter. People are expecting that return on their investment, and so even if they do have a loss for that period, they will take the dividends out of the retained earnings, and that's why they're showing the dividends coming out of stockholders' equity. But for smaller and mid-sized businesses, which make up the majority of businesses in America, they're going to wait to see whether they have a profit or loss. And if they have a profit, they'll pay the dividend. If they have a loss, they generally don't. So I would either put stockholders' equity here, but notice you don't have a profit or loss account here. So that's why there's a choice for profit or loss. That's why they're choosing stockholders' equity. Okay. All right. So accounts payable. Whenever you see the word payable, that means you owe something. So this would be a liability. Right? Cash is an asset. All right. So that's an asset. Service revenue. Now, whenever you see the word revenue, immediately you would think that it is a revenue account. In this case here, it is a revenue account because it says service revenue. However, be careful, because you can have an account called unearned service revenue, or another popular one is unearned rent revenue. Okay, rent revenue, let me back up a second here. When a company, let's say you have a store in a mall, and they ask you to pay your rent on January 1st for the entire year, you're going to prepay your rent. So it's called prepaid rent, right? Now, that's the way it shows on your books, and when you give it to the owner of the mall, okay, they show it on their books as unearned rent revenue. Why is it unearned rent revenue? Because they haven't earned it yet, meaning you're paying, say, $1,000 a month, so you have to prepay the entire year. So you're going to write a check for $12,000 and give that to the owner of the mall. Okay, well, if you only if you only have business for 1 month, and then your business closes, you've only used $1,000 out of the $12,000. So $11,000 is still yours. Okay, you still own that, and that's why prepaid rent is an asset, because you still own it. From the mall's perspective, they owe, when they receive that check for $12,000, they still owe you. Okay, because if, let's say you sent the check on the 1st, and on the 2nd you close the business, well, you're going to get that $12,000 back. Okay, or if you use it for 1 whole month, okay, you're going to get back $11,000. So they owe you that money. So unearned rent revenue actually is a liability account because of the word unearned. They haven't earned it yet. So don't, for the most part, when we're looking at account names that say revenue, okay, immediately you can think in terms of it being the category of account called revenue, okay? However, not all, that doesn't apply 100% of the time. If you see the word unearned in front of that account revenue, whatever that is in revenue, okay, that unearned means it's a liability account, okay? So just be aware of that. Keep that in the back of your mind. And this is, and the thought that just popped into my head was, this is one of those areas where students who try to mimic out of the book, okay, without studying and understanding the concept, they're going to see the word revenue and automatically assume it's revenue, because they're going to look in the book and they're going to see on this exercise, oh yeah, here's revenue, so that's revenue. But when they're applying it to the test or in the real world, they just pass over the word unearned. They don't even think about it, okay? Because why? They see, revenue here, and they automatically assume it's a revenue account, and then they get it wrong because they don't understand the concept. They're just copying out of a book. Okay, prepaid rent, I just went over that. Okay, in the example, when you prepay your rent for $12,000, you own that because you haven't used it all yet. The only time you've used it all is when you get to December 31st, right? So you've used it throughout the entire year. And any portion that you haven't used during the course of the year is something that you still own. So prepaid rent is an asset. Rent expense, just like it says, whenever you see the word expense, you can automatically assume that that's an expense. Okay, just like with payables, you can automatically assume it's a liability account. Okay, and then common stock is an equity account, stockholders' equity, because it's an investment in the business. Okay, so that's I'm at 15 minutes right about now, so I'm, even though this was just one problem, I'm going to stop. And in the next video, I won't go through so much of the spiel, and I'll just try to continue to work on with the problems and see how many we get done. Okay, so I'll see you in the next video.